The president rolling out exemptions to his latest round of tariffs is a very big deal. But before you get too swept up in today's miraculous rally, I want to sound a cautionary note. If that sounds crazy, remember that I was coming out here every day and telling you not to panic when the market was getting hammered. I told you good things could still happen, including positive developments in the trade war with China, like we got today. When Wall Street's freaking out, it's my job to calm you down. Unless there's real systemic risk that endangers the whole economy, which I knew was absolutely not the case this time. However, when stocks explode higher and everyone breathes a collective sigh of relief, it's important not to be too exuberant. In other words, you never want to be making emotional decisions in this game. It's better to rationally take stock of the situation. And that's why tonight we're going off the charts with the help of Mark Sebastian. He's a brilliant technician who's the founder of OptionPit.com, as well as being my colleague at RealMoney.com to get a sense of what's really going on underneath. Mark is our resident expert on the CBOE Volatility Index, the VIX for short. That measures the implied volatility of the S&P 500. Now, we often call it the fear gauge because it's a great proxy for the overall level of panic in the stock market. And remember, no one ever made a dime panicking. So what does he see right now? Well, he thinks the VIX is a little worrisome. First, understand the volatility index and the S&P 500 are supposed to move in opposite directions. Now, doesn't that make sense? When the market's up, the VIX should be down. When the market's down, the VIX should be up. And that's why it's known as the fear gauge. If that relationship does break down, if they travel in roughly the same direction, well, that's the market trying to tell you something, and you got to stand up and look at it. Now, I want you to take a look at this pair of daily charts showing the S&P 500 and the volatility index in 2019. If you remember, back in April, we ran an off-the-chart segment where Sebastian pointed out that the market was rallying and the VIX was creeping higher, too. Oh, man, that was a very bad sign. He nailed this one. See, when the fear gauge is rising along with the market, it often means we are due for a sell-off. Sure enough, the VIX, it was telling you the truth. Once May rolled around, the S&P sold off hard, and it was a brutal month, as you remember. But there's a flip side to this kind of analysis. When the market's falling and the VIX stops rising, well, that usually means we're approaching a bottom. Over the course of May, as the S&P kept making lower lows, and here you can see the S&P going down, okay, the volatility index couldn't even come near its highs. Isn't that cool? I think it is. It seemed anemic. And once again, Sebastian's methodology was right. It made you money again. The market quickly bottomed, and then it roared higher in June. That's how important this is. So why bring it up now? Okay, suddenly the averages are rocketing higher. After getting absolutely clobbered for a couple days starting in late July, as everyone panicked about the new tariffs and plummeting Treasury yields potentially signaling a recession, the S&P 500 caught fire last week. While the averages started rolling over again on Friday, something that continued yesterday. This morning, President Trump stepped in, and we snapped right back. Now, looking at the action over the past week, the S&P's been moving on an average, this is pretty amazing, of 1.1% per day. You know, that works out to be about a 17.5% volatility on an annualized basis, which means you expect the VIX to be around 17.5 because it's calculated based on the implied volatility of S&P 500 options. But check out this zoomed-in pair of charts. Now, this shows the S&P and the VIX over the past 6 weeks. As of last Thursday's close, the volatility index was under 17, down from 24 when the market bottomed last Monday. Nothing alarming here. Remember, when the averages go up, the VIX is supposed to go down. See, that makes a lot of sense, right? That is commonsensical. Although Sebastian would have liked to see the VIX go down below 16. Now, keep that in mind, because that's going to be an important number. Then when the S&P got slammed again on Friday and Monday, the volatility index bounced back to 21, okay? And that's pretty normal. The S&P makes a higher low, the VIX makes a lower high, and that's what you'd expect. We want to see this go back to there. Today, though, the S&P snapped back, and while the VIX came down, it finished the day around 18. While we've had a lot of turbulence, Sebastian's worried that the volatility index seems to be creeping up along with the stock market. Why does that matter? Because as Sebastian points out, over the past couple of years, every time the S&P's had a rapid rally that failed to really bring down the VIX, that's what we had today maybe, it resulted in some sort of sell-off, even when everyone was getting all excited, all bulled up. The most notable one being the big blow-up in January of 2018, when people really went nuts. Now, Sebastian doesn't believe we're in for a big breakdown here, especially not after the recent carnage. But when he sees the market snapping back like this, while the volatility index hasn't really kept pace, well, he worries that the upside might be more limited than a lot of people expected when they saw the news from the president this morning. And just look at today's trajectory, okay? The S&P 500 pole vaulted above 2,900 right at the open, and then it pretty much flatlined for the rest of the session. And that's why Sebastian thinks we may need at least a few days to digest these gains. As long as the VIX stays stuck above 16, he says it's a sign that you shouldn't place too much trust in the rally. So what does Sebastian want to see before he can get on board with this run? He says the market needs to pull back a bit for a couple of days, then hopefully we get a slower, more logical rally. Today's move was not at all discriminating. Not all discriminating. It took up the good with the bad, and that worries me. The winners from the tariff exemption with the stocks that have nothing to do with the exemption. More on that later. Until we digest these recent gains, Sebastian predicts that the fear gauge will stay above 16, and this market's going to chop around. Here's the bottom line. Oh, I know we had a fantastic run today, but the charts, as interpreted by VIX master Mark Sebastian, suggest that you still need to be wary that we may not be done selling off. While he's not predicting a big decline, he thinks you should be prepared for choppy waters and perhaps a modest pullback. The averages haven't really digested these latest gains. And like we saw last week, big moves higher can result in some serious stock market reflux, which is why I keep this on hand. As for me, I like where we are right now, but that's no excuse for throwing caution to the wind. Let's speak to Jerome in Washington. Jerome.
Jim, hello from the left coast. A couple of bond questions.
Sure.
I'm 72 years old and followed your advice. About 1/3 of my portfolio is in bonds. With the new lower yield, should I stay in or switch to more stocks?
No, you're too young. You're too young. I don't want you in these bonds. They're not going to help you. I mean, I'd rather see you in Verizon and Ventas. I'm not kidding. I think that you're making a mistake being in those low-yielding bonds when we've got some high-quality stocks that give you a very good yield. Think Coca-Cola. So let's make that change. If you were 72, it would be a different story. But you're 32. I don't want you in that. Let's go to Sharon in New York. Sharon.
Hi, Jim. How are you?
I'm pretty good, Sharon. How about you?
I'm great. I love your show. You're always a fantastic help. I just want to ask you a question. Now that the market has rebounded today, do you prefer an index fund for somebody in their early 30s? And if so, which one and what percentage do they usually offer?
I'm happy to, I think you went the SPX, or there's a couple of funds that offer really, really low numbers. I'm not going to necessarily name them. You have to do some comparison on this. But I will tell you this. I don't want you to do it all at once, because we've done a lot of work on these big spikes up, and it looks like that you could have a little bit, according to our VIX expert, a little bit of decline ahead. So leg in. Don't put it all in at once, because you'll end up, I think, feeling badly about that. Can you trust this rally? Our chartist says, no, not yet. Not while the VIX flashes a warning sign. I'm with him. He's been so right. The charts are saying volatility and even a modest pullback could be coming as the major averages digest today's gains. So if you're like that caller, please don't put it all in tomorrow morning. Much more Mad Money, including my exclusive with a company going beyond the barcode to help businesses stay on top of things, and also football teams. Then a biotech company with a new way to treat cancer. I know it's up over 150% year to date, but wait until you hear the innovative ways it's attacking tumors. I think there could be more. I'm going to talk with the CEO, with the chairman of Novacure. And all your calls rapid fire in tonight's edition of the Lightning Round. So stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.